Okay, you should be able to see problem 7-03B right now. What we're going to be working on today is that problem, and we're going to be doing the weighted average cost method with the perpetual inventory system. What we have been doing for the past couple of sessions is we have learned about the FIFO method, the first in, first out method, to calculate ending inventory cost. And we have also learned about the LIFO method, last in, first out, to calculate the ending inventory cost. Well, today we're going to look at our third method, which is the weighted average cost method. Again, we're going to be doing this with the perpetual inventory because with the perpetual inventory, we want to keep a record continuously of the merchandise inventory that we have left on hand and the cost of that merchandise inventory. So you may recognize the transactions. They're the same transactions that we started with problem 7-01B. We're just looking at a new method today called the weighted average cost method. And what you probably need to know about the weighted average cost method is that it will result in an ending inventory that is between the FIFO method and the LIFO method. In other words, the cost of that ending inventory will be in between both of those methods. The cost of goods sold that we also are going to be determining when we're using this problem is also going to fall in between the FIFO method and the LIFO method. Now, you'll remember that we said that management could choose from these methods and use whatever method that they deem necessary for their company. And you might remember that the FIFO method, it matches the flow of inventory, the coming in of inventory and the going out of inventory. But it yields the highest amount of net income. So with the FIFO method, you will pay more taxes on that income because your taxes are based on the amount of income, which will be higher if you use the FIFO method. So some management will determine that they will use the LIFO method because it yields the lowest amount of net income, and therefore companies will pay less taxes. There'll be a tax savings with the LIFO method, and with that tax savings, the company reinvests that money into the company to grow the company larger. So a lot of management have decided to use the LIFO method. So the weighted average method is yet another method that we can use to cost our inventory, and this method will fall in between the LIFO and the FIFO. So if you wanted to take the approach management does to where they don't want the highest amount of net income showing or the lowest amount, they might use this method because it falls in between the two other methods. So let's look at this method to see what's going on with it. As you can see here, we had some beginning inventory on April 3rd for this Dune company, and the amount of the inventory was 25 units at $1,200 each. So because this is inventory that left from last period, we're just going to write in the inventory columns the quantity, which is 25 units, and the cost of those units, which was $1,200. Now you can multiply 25 times 1,200 and that will give you the total cost. But in this problem, they've already calculated that for you. The total cost was $30,000. So we're starting with 25 units in inventory at a unit cost of $1,200 a piece for a total cost of $30,000. Now, on the April 8th transaction, what is happening here is we are purchasing some additional units of inventory. Remember, the inventory that we are using here is identical in nature, and so it doesn't have any unusual distinguishing characteristics about it. It's the same inventory that we're buying over and over again. And so the only thing that's happening here is that the purchase price of the inventory has gone up from when you previously recorded the inventory at $1,200. So we bought 75 units, and that will go in our purchases column, the quantity that we purchased. And then the unit cost is $1,240. So you are going to simply multiply the purchased units times the purchase price per unit, and that will give you 93,000. And that's the total cost of our inventory that we just purchased. Now, in our ending inventory on April the 8th, you'll notice that there's just one place where we can record inventory. When we're working with the weighted average method, what you've got to do every time you make a purchase in the perpetual inventory system, we'll have to make an average of the unit cost. So what we're going to be doing is we're going to make some calculations here. So bear with me just a second here. I'm going to try to move this calculator to where it's out of the way here. And so what you have to take into consideration is that you had ending inventory from April the 3rd at $30,000. Then you just purchased some more inventory that had a cost of $93,000. So watch what I'm doing here on the calculator. I'm going to take my beginning inventory cost, which was $30,000. I'm going to add to that my total cost of my purchase, which was $93,000. And that's going to give me a total cost at this point in time of $123,000. And what I'm going to do is I'm going to divide that by the amount of inventory that I have on hand right now. I had 25 units from the April 3rd transaction, or what we brought forward from month. I had 25 units. I'm going to add the 25 units to the amount that we just purchased, which is 75 units. That's going to give me a total units of 100 units that we are going to divide into the 123,000, and that will give me a unit cost of $1,230. And so again, the way that I got the 1230 is I added my total cost of 30,000 to my total cost of what I purchased. In other words, the total cost of my inventory at April 3rd was 30,000. My total cost of what I just purchased is 93,000. I add the two of those together, and then I'm going to divide that by the total units, which I had 25 left over from before, and I just bought 75 more, which meant I had a total of 100 units. So I'm going to divide that 100 units into the total cost, and that's how I get $1,230. Now the total units that I have left now is 25 units from my April 3rd transaction, or my April 3rd date, plus the 75 units that I just bought, which was 100. I'm going to multiply the 1230 times 100, and that will give me my total cost of my ending inventory on April the 8th. So what you have to remember about the weighted average method in a perpetual system, every time you make a purchase, you're going to need to determine a new unit cost for your inventory. And that is the average cost of that inventory at this particular time. Do you understand how I've done this transaction? Now you might remember that before we fill in any of this cost card on April the 8th, we had some journal entries that we have to take into consideration. When we buy merchandise inventory, our merchandise inventory is increasing, or we're debiting merchandise inventory for 93,000, and we would credit most likely accounts payable for 93,000. In this textbook, they're assuming that all the purchases of inventory that you make are on account. So the journal entry would be a debit to merchandise inventory and a credit to accounts payable. We learned that in the last chapter, and so in this chapter, what we're learning to do is place a value on our inventory after each date that we have recorded. We'll put a new value on our ending inventory. And when we make a sale, like we're getting ready to do on April the 11th, what we're going to do is we're going to show in this cost card the amount of the cost of merchandise sold. You will remember that when we make a sale in our journal, we have two journal entries under the perpetual inventory system. The first entry would be to record the sale. On April the 11th, we sold 40 units at a sale price of $2,000 each. So 40 times 2,000 gives you a total sales figure of $80,000. We would debit accounts receivable and credit our sales for $80,000. In addition to this journal entry, we need to show a separate journal entry which will update the cost of merchandise sold and the merchandise inventory account. So we will debit our cost of merchandise sold, but we don't know what the cost of the merchandise sold is until we complete this card. So what we do about the sales transaction is that we sold 40 units on April the 11th. All 40 of those units have to come from the weighted average on April the 8th, which was 1230. To find the total cost of goods sold, what we would do is we would take our 40 units and multiply them by 1230. So 40 times 1230 will give you a total cost of goods sold, of merchandise sold, at $49,200. What we have remaining of the 100 units after we've sold 40 of those are 60 units. We will still be using the unit cost of $1230 because the only time that our unit cost is going to change is when we have a purchase of our merchandise inventory. In this transaction, we were just selling our merchandise inventory. So we're going to take the 60 units and we're going to multiply that by 1230. And that will give you an ending inventory cost on April the 11th at $73,800. So on our sale on April the 11th, our cost of merchandise sold would be debited in the second transaction in the journal for $49,200. Our merchandise inventory would be credited for $49,200. Is there any question about the transaction? All right, let's look at the transaction that happens on April the 30th. Again, we are selling some of the units. Our selling price is $2,000. Our total sales is $60,000. We would debit accounts receivable and credit sales for $60,000. In addition to that journal entry, we would need to debit our merchandise inventory for the amount that we have sold. And we don't have that calculated until we fill out our cost card. So we've sold 30 more units. The amount of our units weighted average is 1230. You will multiply 1230 times, that's the unit cost, times 30 units, and that will give you 36,900. Previously, on April the 11th, you had 60 units left over. You just sold 30 of them, so 30 units would be left at a cost of $12.30 each, which if you multiply that out, it will give you 36,900. Do you understand what I've done in this transaction. My second journal entry would be a debit to cost of merchandise sold for $36,900 and a credit to merchandise inventory. On May 8th, we had another purchase. Remember, when you're using the weighted average method, every time you make a purchase, you have to calculate a new weighted average for those units. So when we purchase 60 more units on May the 8th, in our purchases column, we're going to record that we bought 60 units. And those units actually cost us $1,260. Notice we're in a period of rising prices. You would multiply 60 units times 1260, and that will give you 75,600. And again, every time you make a purchase, you've got to create a new weighted average. And so listen carefully. There are going to be two calculations that we need to keep up with. First of all, our ending inventory on April the 30th was 36,900. You're going to have to add your ending inventory cost on April the 30th to what you just purchased, the total cost of what you just purchased. So 36,900, we're going to add to that 75,600. And that's going to give us a total cost of our inventory at $112,500. Now, what you need to do to get the second part of the calculations is you need to add the previous ending inventory quantity, which on April the 30th was 30 units. We're going to add the 30 units plus what we just purchased, which will be a total of 90 units. And we're going to divide this 112,500 by 90 units. What that will do is give us a new weighted average of 1250. So every time you make a purchase, you're going to have to come up with a new weighted average. Again, we took 36,100, we added 75,600 to that, and then we divided it by the 90 units that we have on hand, and it gave us 1,250 as the new average cost per unit. Now the quantity that we have now is what we had left over from April the 30th, which is 30 units, plus what we just purchased. The quantity that we have now is 90 units. You would multiply the 90 units times the 1250 to get the total cost. The total cost of the ending inventory on May the 8th is $112,500. To understand what I just did in that transaction. So on May the 10th, we're going to record a sale. We sold 50 units at $2,000 each. That's the selling price, which will give you $100,000 in total sales. We would debit accounts receivable and credit our sales for $100,000. Then we will need to show in the cost of merchandise sold, the cost card and the cost of merchandise sold columns, how much we've sold. On this date, which is May the 10th, we have sold 50 units. So 50 units goes here. The unit cost is the last weighted average that you calculated, which comes from May the 8th, which was 1,250. Then we're going to multiply $50 units times 1,250 to get the cost of goods sold for May 10th. Then in inventory, what we have left over on May 10th is we had 90 units for May 8th, but we sold 50 of them. So what we have left are 40 units at $1,250. So if we take 40 units and we multiply it by 1,250, this will give us $50,000. Do you understand what we did on May the 10th? In our journal, we would have debited cost of merchandise sold for $62,500. We would have credited our merchandise inventory for $62,500. Once we have posted these transactions to the ledger, our merchandise inventory account should be showing a balance of $50,000. So you still have to remember the steps of the accounting cycle that we learned at the beginning of the semester. You journalize first, then you post to the ledger, you go through all the steps of the accounting cycle, and eventually you're going to prepare your financial statement. Is there any question about what I did on this transaction? On the next transaction, which is May 19th, we sold some more units. We sold 20 more units. So because this is a sales transaction, we would have debited accounts receivable and credited sales for $40,000. We would need to determine the amount of the cost of merchandise sold before we could do the journal entry for cost of merchandise sold. So we sold 20 units. No, excuse me. Yeah, we're on May 18th. I'm sorry. Excuse me, May 19th. We sold 20 units. So 20 is going to go in for our quantity here. $12.50 is our weighted average cost per unit. And then we're going to multiply our 20 units times $12.50. And that would give you 25,000. So our cost of merchandise sold would be debited for 25,000 in the journal. Our credit would be to merchandise inventory to show that the merchandise inventory account has gone down. We credit it for 25,000. What's remaining in the merchandise inventory account is 20 units at a weighted average of $12.50. And if we multiply 20 units times $12.50, it will give us 25,000. Do you understand what I did on the May 19th transaction? On May 28th, we are purchasing 80 more units at $12.60. That's what it cost us, for a total cost of $100,800. We would debit our merchandise inventory and credit accounts payable for $100,800. We have to record this purchase in our cost card. And again, on May 28th, we purchased 80 units. $12.60. So 80 times $12.60 is $100,800. Remember, every time you make a purchase in the perpetual inventory system, we have to update or calculate a new weighted average cost per unit. So to do that, there are two transactions that we need to do. First of all, we're going to look, or two calculations, I should say, that we need to do. We need to look at the ending inventory from May the 19th. The total cost of the ending inventory is 25,000. We're going to add to that what we just purchased, which was 100,800. That's going to give us a total cost of 125,800. And what we have to do is we have to divide this total cost by the total units that we have on hand right now. Our total units are 20 units that we had left from the last transaction, plus 80 more we just purchased. That's a total of 100 units is going to be divided into the total cost, and that will give me a new weighted average cost per unit at $1,258. Do you understand how I got that amount? You first of all add the total cost of your ending inventory plus the total cost of what you just purchased. Then you're going to divide that amount by the total units that you have on hand now, which are 100 units. That's how I got the weighted average cost per unit, 1258 right now. The total units that we have on hand is 100 units. We would multiply 100 units times 1,258, which will give you 125,800. Do you understand what I just did in that transaction? On my next transaction, which happens on June 5th, we have another sale. We sold 40 units. The selling price per unit now is $2,250. If you multiply 40 times 2,250, it will give you 90,000. When we have a sale, we create two journal entries. The first journal entry would be a debit to accounts receivable and a credit to sales for 90,000. We also have to determine the cost of merchandise sold through the cost card. So our sale on June 5th was for 40 units. 40 units goes into the cost of merchandise sold. The average cost per unit was $12.58 that we calculated from the last transaction. We would multiply 40 units that we sold times $12.58, the average cost per unit, and that will give us the total cost of merchandise sold at $50,230. All right, let me try this again. It's 40 units times 1258 is 50,000. I see I've got a transposition error there. So let me correct that. 320. What you have remaining in your inventory is 60 units. I'm getting that from 100 units that I had left on May 28th, and then I sold 40 more of those units. So what I have left on hand is 60 units. You're going to multiply that by the average cost per unit, which was $12.58. And if you multiply 60 times $12.58, it will give you 75,480. Do you understand what we did in this transaction? We would have had to have debited cost of merchandise sold for the amount of $50,320 and credited our merchandise inventory for 50,320. On the next transaction, which is June the 16th, we sold 25 more units at the selling price of $22.50. The total sales was $56,250. So I would debit my accounts receivable and credit my sales for $56,250. In addition to that journal entry, we would have to create another journal entry where we debit the cost of merchandise sold for the amount. And so you're going to have to figure that amount. And again, this was on June 16th. We sold 25 units at $12.58 for a total cost of merchandise sold of $31,450. The number of units that you had left over on June the 5th was 60 units. You sold 25 of those, so you have remaining 35 units in ending inventory that had a weighted average cost per unit, $12.58. So we're going to multiply 35 units times $12.58, and that will give us the ending inventory, 44,030. So we would have a debit to cost of merchandise sold for $31,450 and a credit to our merchandise inventory. On June the 21st, we made another purchase. Every time we make a purchase, we have to recalculate the average cost per unit. We bought 35 units, so record those in the purchases column. And we paid $12.64 for each of those units that we bought. So 35 units times $12.64 equals $44,250. Well, maybe not. 240. Got to type it in right, or key it in. All right. Now, what we have to do now is we have to make some calculations for determining the new average cost per unit. And to make those calculations, we got to take the cost of our ending inventory, which was $44,030. We're going to add to that what we just purchased, $44,240. That will give you the total cost. Now we had 35 units in ending inventory. We're going to add what we just purchased, 35 more units to that. That'll give us a total of 70 units. The total cost of 88,270 is going to be divided by 70 units. The new weighted average cost per unit is $12.61. We had 35 units in ending inventory on June 16th. We bought an additional 35 units, so we have all total now 70 units that we would multiply by 1261, and that will give us our end inventory on June 21st. Do I have any questions about what I just did there? On June the 28th, we had a sale. We sold 44 units at $22.50 for total sales of $99,000. We would debit accounts receivable and credit sales for $99,000. In addition, we make another journal entry to record the cost of merchandise sold. We don't know how much the cost of merchandise sold is until we figure it out. So on June 28th, what we need to know is what we sold. We sold 44 units. The weighted average cost we calculated at $12.61, and if you multiply 44 units times $12.61, that will give you 55,484. To find what's remaining in inventory, we take what we had left from last date, which is June 21st. We had 70 units. We're going to subtract what we just sold on the 28th of 44 units. That means we have 26 units left in inventory at $12.61. So I'm going to multiply my 26 units times $12.61, and that's going to give me 32,786. So the journal entry that I would make on June 28th, the second journal entry, would be a debit to cost of merchandise sold and a credit to merchandise inventory for 55,484. Do I have any questions about anything that I've done so far? The next thing that you will want to do is total up all of the cost of the merchandise sold for this period of time. We're going to add the entire column together to get the balance that would go in June 30th. So we're going to start with 49,200. We're going to add to it 36,900. We're going to add to that 62,500. and 25,000 would be added. We're going to add 50,320. And we're going to add 31,450. And then we're going to add 55,484. And that's going to give us 310,854. The ending inventory balance will be the ending balance from June 28th. So 32,786 is the ending balance that would go on this cost card. Do I have any questions about the cost card that we just completed? So in the next transaction, they want you to determine the total sales. We'll have to go back up to our information that they gave us. And we start with our sales on April the 11th, which was 80,000. We're going to add it with the sale on April the 30th, which was 60,000. We're going to add it to the sale on May the 10th, which was 100,000. And then we're going to pick up the sale on May 19th of 40,000. We're going to add the sale on June 5th at 90,000. We're going to add the sale on June 16th at 56,250. And we're going to add the sale on the 28th of June at 99,000. This will give us a total amount of sales at 525,250. The total cost of the merchandise sold, we've already calculated. It comes from the cost card columns. For the cost of merchandise sold, the total amount is $310,854. To determine the gross profit, we will subtract the cost of merchandise sold from the sales. So from the sales, we are deducting or subtracting out $310,854. That will leave us $214,396, which is left to cover our to cover our operating expenses. This gross profit is found on the income statement. In part 3, they want you to determine the ending inventory cost on June 30th. The ending inventory cost is our last balance on June 28th, which was 32,786. And this is how we complete the weighted average method. Again, if you could go back and look at the other two problems that I completed, the amount of the cost of merchandise sold will fall in between the FIFO and LIFO method and the weighted average method. The gross profit would also be in between the FIFO and LIFO method. The ending inventory will also be in between FIFO and LIFO methods because the weighted average would fall in between the FIFO and LIFO methods. So management could choose to use the FIFO method, the LIFO method, or the weighted average method to value their inventory. It will affect your financial statements differently depending on which method you choose. FIFO will give you the highest amount of net income during periods of rising prices. So if you'll remember, when we did all of our purchasing, our costs were rising. So the FIFO method yields the highest net income during periods that are rising cost, during periods of rising cost. And the LIFO method will give you the lowest amount of net income during periods of rising cost. The weighted average method will give you gross profit that is in between the FIFO and the LIFO method. So it's not the most conservative method that management would choose, but it is a more conservative method than the FIFO method is, and that is the weighted average method. Is there any question about anything that I've talked to you about so far today? Well, this should give you a head start on some of the problems that you are going to have to do for this chapter. When we come back on Monday, I'll take any questions that you have about Chapter 7, but I want to go ahead and move into our last chapter, which will be Chapter 9. We're going to skip Chapter 8, and we're going to go into Chapter 9, hopefully on Monday, unless you have a lot of questions for me. We'll meet again on Monday at the same time in the virtual classroom. And if you have no questions, I hope that you have a wonderful weekend, and I will see you sometime, I hope. Goodbye.